Okay, hello everyone. My name is Vikas Agrawal and I'm the founder of AIF and PMS Experts India. Well, it's quite some time that we're not doing this recording at our studio because we were involved in doing organizing a large event called AIF and PMS Conclave. So we are back now and we're going to discuss about private credit. Well, all of you know that particularly in cat 2 we are witnessing this particular cat 2 as in of course within cat 2 there are various categories. There are like private credit, there are like people investing in real estate investments, but this piece is shaping up very well in India. We are witnessing that huge number of HNIs and ultra HNIs investors are sort of started evaluating this as an option to invest as their part of the strategic allocation in fixed income. So we thought, why not we'll invite somebody who is good at doing this for many years, and we'll try and read his mind today and know more about how this whole thing works. And how do you, as an investor, how do you take the maximum advantage of this? How do you sort of enhance your overall portfolio return by investing in these sort of offering? So with me I have Mr. Rakshat Kapoor. He's the CIO of Modulus Alternative. Modulus Alternative have been doing this business for quite some time now. They already had one fund with the successful a track record of delivering closer to 17-18% returns in the hand of investors. And then of course they have now they already have one more offering which is going on. We are not going to talk about that, but what we're going to talk about is to discuss the whole thing, how it works and how as an investor you want to take the maximum benefit out of that. So let me have the privilege of introducing Rakshat. So Rakshat, first of all, thank you so much for taking the time out from your busy schedule and coming all the way from Bombay and agreed to speak to all our investors.
Oh, thank you, Vikas, for having me on your platform. So it's a good privilege and happy to speak to your investors through your platform.
Right. So let me first introduce Rakshat. So he brings about more than 2 decades of experience on the table when it comes to particularly the private credit side, more particularly how do you restructure the overall thing. So he brings about more than 2 decades of experience. Currently he's the chief investment officer at Modulus. So prior to this he's worked with large organizations like Nomura Securities. He's also worked with Deutsche Bank on the private credit investments, and all this while he's basically looked at various turnaround situations. How do you restructure basically the large private credit side. He's also managed the distressed debt and private equity across the capital structure in different sectors. So we thought since you've already done these many things, we thought who would be the better mind than to talk to Rakshat and understand how do you look at the private credit and how do you look at the whole thing, particularly the cat 2. But before we go to talk about, so Rakshat, just want to understand, can you for the benefit of our audience, can you introduce yourself a bit, like you want to share your experience and also talk about your organization, how it is structured in India?
Sure. So hello everyone. As I said, thank you so much to Vikas to having me on his platform. So happy to share my experience and what I have been doing in the private credit. So before about Modulus Alternatives, a little bit about myself. So I have been doing debt investing or private credit investing across all my 3 different jobs between ICICI Bank, Deutsche Bank and Nomura Securities. And I've kind of seen how the whole evolution of credit investing in early 2000s across various cycles, and then later on in 2018-19 across how the debt-led crisis also shaped up, and within that all these cycles have been since consistently investing, and what are the risks that this asset class really brings while you invest. As I said, across my 3 jobs that I did with these 3 organizations, I somehow thought that if India is sort of growing in that 6, 7, 8% economic growth and the whole the tailwinds that our India is having, there would definitely be need for a stronger corporate credit growth, which was largely historically being met by banking industry, para banking, which is NBFCs, and I think to some extent that sort of came up with mutual funds. And I think if you look at all developed economies, large part of non-vanilla exposures, outside of traditional project financing loans, working capital, supply chain, etc. I think corporates really resort to private capital funds to really either feed themselves or even to sort of take money as from a growth capital or for a mezz capital, etc. So I think with that objective and with that sort of conviction in the asset class, I sort of founded this Modulus Alternatives, which is part of the overall Centrum group, and started with our journey on private credit investing in from September 2018. As I always said that it's never about things always in an Excel sheet. So when I really Vikas started, I think on that day DHFL had sort of fallen 56%, and I think maybe I thought that there is just market aberration on that particular day, and I think as days passed and as weeks unfolded, it sort of led to a larger debt-led NBFC sort of crisis, and of course that was there was a lot of shortage of liquidity and other things that sort of consequentially led. But that's how we that's the kind how we started the entire private credit journey and private credit investing.
So what is Centrum's role in your organization?
So Centrum is Centrum Capital Limited is the overall sponsor and the overall parent for the organization, and under their umbrella Modulus Alternatives, which is a 100% subsidiary of Centrum Capital, is how it's the investment manager and sponsor for all our private credit funds. So that's the broader nature of and that is this entity is primarily sort of founded by myself, and in this entity we really then started this whole, as I said, the journey of the private credit.
So this is only private credit, or you're doing anything else under this umbrella?
No, as of now, I think the focus of the alternate asset class, the focus is on the private credits. I think this space itself is so big and so humongous that I think we have done Fund 1 and now we are now embarking a journey on the Fund 2. So we are, I think we're just sort of, developing this asset class within this more and more.
So this is like an independent entity in the sense that while the Centrum is your sponsor, but all the investment decisions are taken by you and your investment team. Is that correct?
So I would say that the business is predicated on all third-party capital. Wherein all the capital that we raise is really from independent third-party sources, and as a result it had to have that character and feel to it in terms of it's how day to day the functioning has to be a lot more independent. Having said that about how the investment decision making process works, so there is a obviously there is an investment team who sort of scrutinizes and diligence all the investment proposals. There is a very I would say rigorous diligence, and eventually you sort of reach out to investment committee evaluates all the transactions, spends a lot of time, advises, gives feedback, goes through it in terms of greater detail, and then approves a particular investment. And credit is also an asset class where, as I said, it's a very staged wise process. For example, you look at a particular investment, you have a preliminary view, then you do a diligence, then you again go to committee, and then I think the committee really sort of takes a view around it, in terms of doing it or not.
So Rakshat, before I talk about the sort of framework that you follow at an organization level, I just want to if you can speak to our investor and simplify the whole thing of how this private credit CAD 2 investment is shaping up, and how do they take the maximum benefit out of the whole thing. I mean, if you can simplify this the whole structure.
Sure. So I like to answer it in maybe two ways. One is what is private credit, why there is a need for private credit, what sort of companies that come to a private credit platform, and maybe on other side, on the liability side, how investors would invest in an AIF and what's the overall structure. So maybe I'll pick up the asset side first in terms of how investing. So as I said maybe earlier in the conversation that typically the way, if you look at any corporate in India, depending upon its credit profile and depending upon its need for capital, they would either go for raising equity or for raising debt, right? I mean, if you want to raise debt, you would also, depending on, for example, if you are a typical high grade rated borrower, you would have a working capital need or a usual supply chain cash flow backed financing transactions that would really go to typically a banking framework or a para banking, as I said, NBFCs, for example. Right. But in any life cycle of a corporate, there would always be stages where a company would, probably wants to, say, for example, raise equity. Public markets window is not that great. Markets are volatile. So what do? You probably would want to come to a alternate investment platform fund and probably raise that bridge capital, a mezz capital, and things like that. So that's one end use. Second is, for example, a company is putting up a brownfield or a greenfield project. Now, of course, they would go to a typical bank to take financing for that project, but there would always be an equity contribution that the company would have to put into that project. So either the company would have their own internal accruals or backed by adequate cash flows in the company, or they would again go to an alternative asset platform to sort of bridge that gap and put in or raise that equity. Or maybe variety of other needs. For example, a company is buying another company and some of those end uses are not really permissible under the central bank regulations. So sometimes either due to the need of capital, timing, or for that matter end use, you normally come out of your traditional sources of financing, which are bank and para banking, etc., and probably would want to come to a platform. So that really addresses the need of why a corporate really comes to a AIF. I mean, a lot of people actually ask me this question: why would this company come to you? Is that means the company is not doing good, or is it not? I mean, why? And that's the reason it has come to you. So that entirely is not correct. So as I said and as I explained to you, in some of these reasons, that's how the company really comes to a alternative investment platform. Now, let's look at the structure. I think I mean.
So before we move,
sure.
One short question. So you reach out to them, or they reach out to you, or it's a combination of both?
I think it's a combination. I think while we started investing into this into the corporate, so as you invest, the companies would also get to know more about the platform.
Sure.
And as a result, I think the word really spreads. A lot of people would sort of get to know that, okay, there is also this AIF or a lending platform that sort of invests in these type of transactions, and so it's a combination of basically both, that how it really works.
And your team keep evaluating the better options.
So I think from that perspective, I think and I'll touch upon the investment strategy later in the conversation. Sure. But I think the proposals would come. I think we would also identify in terms of what you want to really invest. Sure. For example, we are in particular a very sectorally driven platform from a credit perspective as well, and we would want to see transactions more from a filtered sense of where we would want to see pocket of growth or what we think a particular theme or a sector is probably doing. So that's how we probably would be more clear that side. Yeah. Now, coming from, let's say, from an investor standpoint, this is as I said, I think SEBI has done a great job of actually starting this whole platforms of AIF, etc., which gives us a huge window of opportunity for investors to participate in a very, very well governed and a highly risk managed basis. And I'll sort of cover that in more in detail. So for example, this is a category 2 AIF. Category 2 is a kind of AIF which is not allowed to, for example, leverage. Among other differentiations, it is not allowed to leverage. So just to give you a comparison, when you an NBFC has funds itself through a mix of debt and equity, and then that capital is really lent to corporates, whereas on an AIF you really raise capital from these investors primarily as a commitment and as a capital contribution, and there is no leverage in it, and you use this capital to really invest.
Yeah.
So that's how that's the kind of architecture. Second is these are closed-ended funds and these are not open-ended funds. The idea is that once you raise an X amount of capital, based on your strategy, based on your due diligence, investment focus, etc., you would probably invest. Then there will be a period in which those investments will probably harvest, or what you monitor those investments, and then towards the rear end of the fund, this investments would probably give their returns or the capital back, and that's how you go back to investors and return their capital. So that explains the the overall total, the tenure and the closed-ended nature.
Sure.
Third is all the funds, or I would say most of the funds, once an investor gets onboarded, so he makes a particular X amount of commitment towards the fund, and say for example you can pick up any number, and that commitment is not drawn down on day one, that's also drawn down over a drawdown period. And the reason for a drawdown period is like if I take all the capital today with me, but I don't have all the transactions at the same time that I have to invest. So what the fund investment team does, it draws down the capital from the investors as and when they think they have a transaction or they have a compelling investment opportunity which meets the criteria, and that's how you draw down the period. So that's how you draw down the commitment. So that's the nature and the architecture of how the investors get onboarded and then sort of gets to invest, and that's how towards the rear end the money really comes back.
Right. So now you also talked about you just touched that and there are a lot of investors when they talk to us, because we are one of the largest platform when it comes to investing in both alternate investment funds and portfolio management services. So when they invest, the first thing that they look at is the kind of risk which is involved in the fund. So I just want to read your mind and understand how do you manage risk, because ultimately you're giving money to corporates, you're investing in them, but then there would be some corporates who may not do well, or what they expected, they may be good, their intentions may be good, or they bring good amount of integrity on the table, but what they expected, the cycle turned around and they could not achieve what they wanted to achieve. During that situation, how do you do it, and how many overall transactions you do it, and what's the risk parameter you look at?
Sure, so that's a very interesting question. I'll start off like this, that when you make any investment in any asset class, there is always a commensurate risk to it, and accordingly the return profile sort of gets graded alongside the risk. In terms of private credit, and I'll probably speak more about ourselves, how we sort of see risk and how we structure and manage risk, because that's a very important, or I would say probably the most important aspect of investment in this and other asset classes. So from our perspective, I think as I said earlier, we are at any point of time we identify certain sectors or certain themes in which we think that there are either the tailwinds are good, or for that matter there is a good growth outlook. For example, in the current context, I think the whole space of industrials and capital goods, for example, is showing a lot of I would say green shoots and a lot of growth outlook, primarily because of the government's thrust on the whole capital expenditure, or for that matter indigenization on manufacturing and things like that. So this whole sector is upbeat around in terms of the growth outlook. So then we would go a step further. We would look at companies that are identified within this category. Now of course there will be some segment of companies which are very large, which are very high grade, so if they have to raise capital, they would not really come to an alternative investment platform. So you probably would look at a mid-sized corporate company which as I mentioned earlier, in some of those end uses that probably fits in your criteria. Of course then each investment fund has its own strategy, but we would probably look at a lot of emphasis around the quality of promoters and management, especially in this segment of corporates. You will spend a lot of time in diligencing the company in terms of its cash flows, in terms of its past historical financials, in terms of its basic financial metrics and operating credit profile. And thereafter you based on a certain transaction structure which comprises of a tenure, a security, a credit conditions, a covenants, a repayment profile, the monitoring mechanisms, the business plan, etc. You probably you probably take an investment decision and probably invest. Now in terms of I would like to highlight certain key risks that sometimes people do tend to ask, and sometimes things can go wrong, and some of these things and how we really manage it. So first is, I think the business itself. So from our standpoint, I think whenever we analyze business or we analyze the quality of earnings of the company, I think to us, the whole return on the capital employed, the whole return to the shareholders, the profitability, capability of the company to sweat and return on assets and return on equity. So some of these yardsticks for us are important, because I feel that I think if in any business, I think if there is a higher return that is generated for a shareholder, I think the debt returns sort of get sort of adjusted into it, and sort of there is a high probability that the companies would not sort of have a dismal performance going forward. Second is moving away to, I think, the transaction structure. I think structuring of a transaction from its cash flows perspective in terms of its security is also very important. So for example, you would want to be closest to the source of cash flows and not probably lend money to a left pocket, right pocket, or probably to far away from where the source of cash flows are really coming in. Or going further, for example, when you try to secure your transaction, so there is a security mechanism that you always have in any debt transactions, and security could be a combination of shares, it could be combination of real estate, it could be combination of a company's own assets, land, building, plant, machinery, etc. So that's a combination that you normally do. But what I'm trying to tell is that in a private credit asset class, I think there is a the investment team or the fund spends lot of time in analyzing these credits, in forming a view, and then structuring it very well based on your investment strategy that you have laid out in the credit fund. And it does take people between 2, 3, 4 months or even longer sometimes to stitch up a particular transaction, and that's how it sort of crosses a finish line. So like you asked, Vikas, that how many transactions you sort of end up doing. So for us, if I just look back in last maybe 4.5, 5 years, I would say that we have done about, say, 15 investments over 4.5 years. So as you can see that it sort of broadly adds up to 3 or 4 transactions a year. So
but did you face any issue all this while? Because during the COVID time especially, do you see out of this 15 investments, any of them is backfiring?
So I would say that I think thankfully we had a very good run. I think we have a good successful track record in terms of how we have managed risk. Happy to say that even during peak COVID period, your volatile period of 2019, etc., and then entering into pandemic 2020, I think we didn't had a single day of delay or delinquency and defaults in the fund. So it has a good experience. Happy so I hope it just sort of continue. But in terms of I think an important aspect which is correlated here is that in all these investments, one of the very important aspect is that once you invest, that's how your real work really starts. I think active monitoring of your investments in terms of your follow-ups with the particular portfolio company, in terms of its operational profile, in terms of what they're month on month they're really doing in terms of operational production, capacity utilization, contribution, gross margins, etc. I think some of those yardsticks we try and track very rigorously over any month to month basis. So for us, I think maybe I will if somebody asks me how come you have sort of done well, I think one point I will definitely say that what we have learned is that I think our focus on active monitoring on each of our investments has helped us in sort of probably staying ahead of the curve in terms of being ahead in terms of to sort of manage any issues upfront.
No, great. I think if there are investment managers who are doing fantastic job, you're one of them. I think ultimately investors should make money. That's the goal that all of us have. So Rakshat, before we conclude, last question from my side. So while there are investors, HNIs investors, ultra HNIs investors, they have been investing in mutual funds, fixed income instruments for quite some time now. On the other side, the direct investments on the fixed income, both put together, are in the tune of 8 to 9% as we speak today. The maximum that you can look at, you go ahead and extend your variety of instruments, you can have double-digit growth. On the other side, you have a track record of 18% gross I'm talking about. When I talk to our investors and share this perspective, they some of them, and this is the reality, come with a pre-mindset or sort of perception amongst these investors, and not to blame them, because they would have burned their finger with IL&FS crisis, or way back in your stock exchange, that spot exchange which got bellied up those days. They were offering 12-13% sort of interest. So my question to you particularly is that how do we address this?
So I think maybe a tough question to answer, but I think look, whenever you invest in markets, you invest in asset classes, I think one always have to prepare for some of those unknowns, some of those volatility and things which are beyond macro outlook, etc., can always happen. Second is, I think of course, yes, in credit investing especially, I think there has been a long spell in India where there has been an NPA-led crisis, and then NBFCs, etc., and then there were some issues maybe that people faced in mutual funds, etc. But I would say that I think pretty much how to sort of mitigate some of these things, a private credit AIF is sort of I would say a good option if anybody would want to allocate income or invest in a credit driven instrument. And the reason is that that, as I said, in a credit AIF, I think the level of first of all, you have a very dedicated investment team which only focuses on credit investing. So to that extent, I think things are a lot more mitigated to that extent, unlike say some of the other I would say in other frameworks where I would say there's a lot more volume and there's a lot more breadth of the capital that really needs to be managed. These are dedicated funds which has a dedicated investment strategy, and to that extent there is an expertise that some investment team brings to the table. So that's point one. Point two is that if I look at from an investor's hat, if I would sort of allocate money within the entire say fixed income chain, so say on the upper end you will have a a liquid fund category, then you would probably have a AAA, AA category where I would say it is less of credit and more of a correlation to an interest rate scenario.
High duration.
Correct. Yeah. And then I think when you step outside of these two buckets, and then you look at the next level of risk and the next level of investing, I think that is where a credit AIF would sort of make complete sense, because I think while a headline number of our first fund looks good, but I think even from a even if probably you would have a lower returns, but a 12, 13, 14% return on a pre-tax basis to investors consistently from this asset class over the tenure of the fund, I think is a very good, very good return. And I think if you can sort of beat inflation 2 times, I think it's sort of it's I would say it's very good.
Even if you look at and compare that with equity as an asset class, you look at last 10, 20, 30, 40 long years of the returns, it boils down to 12, 13, 14%.
Correct. And I think if you can compound your returns at 12, 13% every year, I think it's a good
job,
investment destination.
Yeah.
And that's how I would sort of probably sum up and say that I think outside of these two buckets, and again it really depends upon the risk profile, but I think anybody who's sort of looking at an allocation to fixed income, allocation to credit, I think credit AIFs probably would make a complete I would say compelling investment option compared to other things that are sort of available today.
Right. So with that, we'd like to conclude the session here. I think it was great interacting with you.
Thank you,
we
Vikas.
learned a lot about private credit, how it works, and what we are witnessing, as I said, that this space is going up very kick, but if I have a cup of coffee, I don't expect that kick to take place. But at the same time, you need to also understand that when you're comparing mutual funds with credit funds, private credits, it's not a right comparison. It's not a peer-to-peer comparison. You also need to look at and change your lenses and see to it that within the private credit, which are the ways that you can enhance your return by taking some amount of calculated risk, which is very important. And I'm sure with SEBI giving this kind of flexibility of you setting up the escrow account, you working closely with promoters, you going along with their businesses, looking at their numbers, predicting the future, looking at their cash flow, hand-holding them and guiding them. Some of the credit managers are gone to an extent of doing that. With that calculated risk, it is very much doable. When you put efforts, obviously going to get 13-14% kind of returns in your hand. And there are managers like you who deliver 16%. I think to my mind, it's a very good number, even at a gross level. So I would say that keep up the good work, and many thanks. Keep creating the wealth of our investors, and thank you once again. Thank you.